Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The WASDE report from last week was bearishly received, and as we can see from the price action on the chart, the markets did move down very strong. Since then, the market did find support, as we can see here for the September corn contract at about 353, and the market moved up from there, especially after word of the US and China having some potential talks. Since then, not much has come from those rumors, and we can see that the market has given up those gains, but not before finding good resistance near the 370 level. The market did find very good resistance up against our 1x1 angle, and from here, as we move forward, we're looking for a potential turning point. We do think that the corn market could potentially find some support near the 355 to 358 number, and if it does so next week, we could see a sideways to slightly upwards market moving forward for the next couple of weeks. The time factor that came in on the horizontal tangent to the arc swing showed that the market responded in kind after hitting volatility-based resistance. From there, the market did give us that very nice decline in conjunction with the WASDE report. And right now, we find very good resistance up against the 225-degree mark of 371. From here, the market could potentially run lower. If we get subsequent lower lows over the next couple of trading days and early trading next week, what we would look for is whether or not the market is able to break the previous low. In doing so, we would then look for a retest of previous lows. If the market's able to hold support next week and stay above the 350 to 355 mark, then we would look for the market to potentially make a move to the upside prior to a harvest decline, and at which point we would look for some potential resistance closer to the 380 mark. The December contract is moving in kind, and we can see an important time factor has now hit, where we have an intersection of our 1x1 timing angles, and that can sometimes cause for us a potential turn in the markets. The market did make a significant low after the WASDE information. Then it made its advance, and we can see here that the time factor suggests that we could very well be looking at a few more days to the downside. And so similar to the September contract, this previous low is going to be a significant level for the balance of next week. So we're looking for 365 for the December corn contract as being a very important level as to whether or not we're able to see the market make a rise and perhaps test somewhere in the neighborhood of 392 in the not too distant future. The low for the December contract was in conjunction with the time factor of August 13th that we had mentioned previously, and we can see that our point of control number of 370 held up very well, as this is essentially where the reversal occurred for the December contract. Again, the market has since moved up, and we're seeing a reversal of the gains from Thursday right back on Friday, since there's been no follow-through with the rumors from the China-US talks. The biggest move of the day was on soybean, and understandably so, since China is a major consumer of soybean, and as we can see, like the corn market, there is not very much follow-through for the gains from yesterday. The market's given up about half of the gains on the day, and we're looking for key support to potentially hold somewhere in the neighborhood of 850 for the September soybean contract. We did find resistance up against our arc swing, but from here, we are looking for a potential low to set in for soybean, where we're looking for about a week to 10 days of an advance before the next potential leg to the downside. Our next time factor for the September contract rests on August 22nd, and so we anticipate that this could very well be our next potential turning point. So what occurs over the next couple of days on Monday or Tuesday as to whether or not the market's able to move up to this area or it continues to decline into this area will be the key signal for us as to the next opportunity for directional follow-through. The advance caused by the rumors yesterday, we can see found very good resistance up against our sinusoidal trend line, and from here the market did reverse. Previously, you'll also notice that the midpoint of our sinusoidal area was where support came in, and so once again, these two levels have been significantly important for this contract. Now from here, we are looking at our point of control level that sits at 870. We've discussed that quite a bit. And so for the November contract, we'd like to see 870 hold if this market is able to make an advance. Breaking below 870 would suggest for us that the market's looking to retest previous lows sooner rather than later. So this 870 mark is going to be very key for next week for the November beans contract. One of the telling signs that beans is due for another decline potentially to the downside is that we can see that the big move down was in conjunction with very strong momentum. We've since have gotten an advance, but that advance was on very weak momentum itself. That suggests for us then that the market is due for another leg to the downside where the momentum could very well come back in with some strength, and from here we would see a final leg down. For those of us who might be Elliott wave technicians, this is analogous to a big wave 3 movement to the downside, which is typically your strongest impulse move. And then from there, when you see the pullback, this is our wave 4 corrective move. The market would then be due for one more move to the downside, which would be our final leg 5 movement. But there are occasions where our wave 5 is a failed wave 5, and what is meant by that is that the market would come in and give us a downside move, but that downside move would fail to eclipse the previous low. This is the stage in which we're in right now, but we do look for the market to give us at least some downside momentum, and on the next leg down, whether or not it's able to eclipse the previous low or simply give us a new low is going to be the critical threshold that we look toward. For now, the key component is taking into consideration the fundamental narrative. The reality is that we're looking at record numbers of yield potentially, and because of that, if the market is not able to absorb the huge supply, we would anticipate continued weakness for soybean. If for some reason the U.S. is able to negotiate something with China and is able to instead find a path of absorbing some of that supply, we would expect that there will be an initial jump, but the reality is that there is still a huge supply that needs to be addressed, which still makes for a potential downside for soybean. Despite the recent decline in wheat continues to show that it has great potential strength. When looking at the move from the July low up through the recent highs, the market has only retraced about 50% of its move. That being the case, when a market retraces somewhere in the neighborhood of 38 to 50% of its move and finds support at that level, this continues to be a bullish narrative for markets when the retracement can only make it to about 50% of its previous advance. Here we find that there was also great support at our 180-degree mark of 524, and we discussed how if the market was able to hold support here, that the potential for the next leg up breaking previous highs and potentially making it up to about 595 was realistic. In fact, if the market is able to continue with the momentum with which it's had, we anticipate that it would eclipse 595 and potentially reach somewhere in the neighborhood of 610 and maybe 650. But for now, our minimum price objective sits at 595, and the market is about a third to half of the way there from the decline that it previously had. Disruptions in Russia and the Black Sea region in the wheat complex has made for great support for wheat. In fact, the market has come down to our volatility-based support band and touched right at the bottom end of the support region at 530, and from there the market has reversed back up. We would then anticipate that the market can make an advance, and we see our volatility bands that had previously been in the 595 to 610 region have now made a shift to the upside, suggesting that wheat in fact is looking for continued upside momentum, and so we're feeling very confident of the minimum price objective of 595 with the possibility of making it up to about 620. So from here we would look for continued action to the upside for wheat, as the market has found very good support at good levels. The U.S. has recently engaged in some financial warfare with Turkey, and now we find that the U.S. dollar was able to break out and reach up to our target of 96.60, and again, this is where the market found some good resistance. We were looking for 96.60 to 96.50 to be potential resistance, and that's exactly what we've gotten over the last couple of days. But if and when this market's able to break through this 96.60 number, we anticipate continued strength to the upside. Part of what we're seeing here is that the market had made a very strong advance, and then we saw a very long and pronounced consolidation phase. And now the market broke out of that consolidation phase. So once it's able to break that key threshold overhead, we would look for the market to mirror the move to the upside on the other side of the advance. The US dollar could very well make a reach up to par if it continues in this direction. The weekly chart obviously shows much of the same. We can see this consolidation phase, the advance up into the move, and the mirror move on the other side would be something close to the par mark, or 100, as we discussed previously. So it's very important as to whether or not this market's able to stay above the 96.20 to 96.50 range. And as long as the dollar is able to do so for the next week or so, we would anticipate that continued upside strength is probable. Now, in the event that the dollar breaks back down below the 96 range, we could see a potential correction that comes back down, but we don't foresee the market getting much lower than 92, and at which point we would again anticipate an advance to the upside. But for now, it is looking as if the market wants to hold above that 96 range and make an advance up to about 100. Thank you so much for joining us for our regular market update. We look forward to touching base with you again next time.